In today's video, I'll be examining the shockingly real difference of retirement at age 60 that most financial calculators completely miss. And I want to talk to you about why it's dramatically higher than what you've been led to believe. Over my many years of helping people retire, I've discovered that conventional retirement calculations systematically underestimate how much you'll actually need to retire comfortably at age 60. And that's exactly why I'm making this video for you today, to show you the true cost of retiring at age 60, why traditional retirement calculators give dangerously low estimates, and how you can determine your personal retirement number that will actually support the lifestyle that you want to live in retirement. So let's get right into it. I first need you to understand and comprehend this retirement calculation illusion that I just spoke about. This happens with most generic retirement calculators that you may be looking at online or through your 401k platform. Most of the calculators that you've seen, they do underestimate how long you're going to live in retirement, along with underestimating the actual cost of inflation that you'll probably experience in retirement as well. These two miscalculations, they can dramatically affect the amount of money that you're going to need for retirement. In addition to that, these calculators often overlook what I call the sequence of return risk, which is essentially the effect of a negative market on your portfolio, drawing down the assets sooner than you want them to. This leads to an overconfidence in the 4% withdrawal rule that a lot of people generically use in retirement as well, in addition to what these retirement calculators plug in. All of these seemingly little errors, they can add up to be a massive miscalculation in the amount that you're going to need to comfortably retire and stay retired for the rest of your life. I also want to add here that the 5-year gap between Medicare eligibility, which starts at age 65, and your retirement age 60, it can create a massive cost difference in your healthcare expenses and premiums if you don't properly plan for it. In our Red Zone retirement planning process, this is something that we dive deep into and that we assist our clients with every single time we do a retirement plan, starting from age 55 really until 60. I just want to briefly say here that Affordable Care Act insurance, it's a great option if you can control your adjusted gross income during these pre-retirement years before Medicare kicks in at 65. This can only be done if you properly do tax planning and you also live in a state that has favorable Affordable Care Act rates and coverages for you. Let me just give you an example here that we worked with recently. Some clients that we've been working with for several years finally were able to retire at age 58 and 59. So after the 2 years of working with us, we were able to assist them in building up cash reserves, strategically spending down their IRA assets, and getting them a stream of qualified dividends to live on all of these things from age 59 to 65. They were looking at an adjusted gross income of around $75,000 per year for the next 5 years through our planning process. And believe it or not, the client's Affordable Care Act insurance here in Nebraska was under $400 a month for them. These clients were really scared to retire because this fear of the unknown, this cost of the health insurance that they were so afraid of. But once we showed them their income, $75,000 adjusted gross income, and their healthcare cost, they actually were able to decide to retire and were retired within 2 weeks of us giving them this information. Now, I do want to say here that these results can vary from state to state, so please make sure you look into your health insurance expenses with your CFP before you decide to retire. Also, some of these calculators that I previously referenced, they may also show you starting Social Security at a younger age. Take 62, for example, because technically you're retired at this time, and they default to turning on income sooner than later. This is honestly a dangerous move in my opinion, because if you start Social Security at age 62 versus age 67, you're going to take a pay decrease of 30% for the rest of your life. And if you live to be in your mid-90s, this could be a drastic mistake that you made early in retirement, causing you to miss out on large sums of income over the course of your entire life. Understanding these calculations flaws, it's crucial. But even more important is recognizing the specific expenses that most early retirees severely underestimate. So now let's talk about these expenses that drastically increase if you retire at age 60 versus delaying it to your late 60s. The first one I briefly spoke about, but it's healthcare cost. What I didn't say about this couple in the last example is that they had an out-of-pocket maximum of $14,000 each and every year until they were on Medicare. And they lived in Nebraska in addition to that, which really has favorable ACA rates and favorable Affordable Care Act coverages. But if these clients would have had to take COBRA, which is what they were looking at before they came to us, they could have been paying close to $2,000 per month for their health insurance extended through their employer plan. That right there made retirement out of reach for them, and it's why they thought they couldn't retire until they went through our Red Zone retirement planning process. Pre-Medicare coverage can vary widely from state to state and from couple to couple, and it really depends on your income, where you live, and of course, your utilization of the insurance as well, how much you're going to be using for your out-of-pocket expenses. Now, make sure you check into this well in advance if you're planning for an early retirement. For many healthcare costs, it's the deciding factor in retirement at age 60 versus waiting for Medicare at age 65 because of the massive monthly cost. Inflation is the next one that I want to hit on here. This impacts early retirees much more severely than traditional calculations suggest because of those extra 5 to 7 to 10 years of compounding inflation over the course of your entire life. A 30-year plus retirement time frame, it dramatically amplifies those inflation effects, especially the two big ones, healthcare and long-term care related costs that often rise in your 90s. These two things, generally they increase a lot faster than overall inflation. And when it's not a factor inside of your plan, you could run out of money when you need it the most in your later years in retirement. The last expense that I see the largest difference in that people don't plan for is travel and leisure expenses, along with home modifications. Now, let's say you move and you retire at 60, or you want to make these home modifications at age 60, or you're retiring at a younger age and you're just a lot more vibrant and active. Retiring at age 60 versus your later 60s is going to lead to a lot more travel activities, which cost money, and home modifications and upgrades, which will cost money as well. So now that you understand the true cost of retiring at 60, if you're looking for more help with your retirement plan, just fill out the questionnaire in the description below, and I'll send you a personalized video analyzing your specific situation and showing you exactly how much you're going to need to retire. Now let me show you and talk to you about the real retirement number that you have to plan for. The article that's referenced below, it says this: if you're currently earning a salary of $100,000 a year, you should aim for at least $800,000 to $1 million in retirement savings by the time you're 60, which is 8 to 10 times your income. But it also states that the average person that's 60 right now only has around $200,000 to $250,000 saved. Now, I'm sure you noticed this. There's a massive difference between $250,000 and $1 million. But honestly, the 8 to 10 times income, it's also dangerously inadequate for early retirement at age 60 that I've been talking about. And it's potentially well under how much you actually need if you want to retire at that age. So if you were to use the traditional 4% rule at age 60 that a lot of people use and a lot of online calculators use, it can create a significant failure risk for early retirees. But why, you may ask? What's this big risk, Adam, that you're talking about, that all these experts and professionals are missing? Well, there are many, but I just want to talk to you about a few right here real quick. The first one is obvious, longevity risk. I believe, and studies are going to show, that actually you're going to live a lot longer than you thought if you're alive at age 60 or 65 today. In addition to that, these calculators, they don't take into account to the spending stages that you're going to go through in retirement. And what I mean by this is you're going to do a lot more spending in those first 5 years of retirement if you retire at age 60. Because normally what I found that people do between age 60 and 65, if they're still working, is pay down a lot of home debt, pay down all auto debt, do a lot of home repairs and remodelings to really prep for retirement. It's just things that you want to do that you've been putting off your entire life. Most people do those from 60 to 65 while they're still working, along with a lot of big trips. They take that extended 2, 3, 4 week vacation while they're still working. Now, if you're working, you pay for it through cash flow through your paycheck. Easy. But if you're retired, those expenses have to be paid for through your investment returns, which is a big risk. Also, sequence of return risk, which is a down or a flat market. That is a massive risk that can cause you to run out of money in retirement. All of these things can easily be prevented with some guidelines that we coach our clients on, that we use in our Red Zone retirement planning process. And here's a few of them that I just want to highlight for you. The first one is this: We always coach our clients that if you're retiring at a traditional age, say 65, 67, or 70, you should have 12 to 18 months worth of living expenses on hand in cash to help pay for things in a down market. But if you're retiring at age 60, we always coach our clients that you should bump that up to 18 to 24 months worth of cash on hand if you're retiring at age 60 to again use if there's a down market, or keep your income low enough because you don't have to do IRA distributions to allow you to get a more Affordable Care Act policy to live on. The next thing you should do is get your accounts guaranteed that you're going to be spending in the first 5 to 7 years of retirement, strategically claim your Social Security assets, and you need to plan out your tax bracket to adjust for ACA coverage limits. You also at this time should be beefing up your HSA account to pay for any medical costs that you're going to incur. And I like this to be at least 2 times your annual health care plan out-of-pocket maximum to help pay for those out-of-pocket costs so you don't have to take it from your investments or emergency savings. In addition to that, you really got to nail down and plan for any extra travel or leisure expenses or home modifications that you're going to be doing from age 60 to your mid-60s. With these realistic retirement numbers in mind, let's now examine how different income sources need to be coordinated for maximum security when you retire at age 60. For this, I want to turn to our income planning resources that we use in our Red Zone retirement planning process. These are tried and true processes that will help you ensure a comfortable and stress-free retirement. And I teach all these concepts in my book, The Red Zone Retirement Plan. It's available on Amazon or my website, Adam D. Olson, if you'd like to grab a copy. The first thing that you have to do is this. Build up those cash reserves that I previously mentioned, and they should be at least 18 months plus worth of living expenses that you have saved up. If you're retiring at age 60, and you have to plan for that 30-year plus retirement. Also, assume inflation at 3%, and you need to set your spending stages so you have some go-go years, slow-go years, and no-go years. What this means is this: in your early 60s, really for the first 10 to 15 years, most people are going to be more active in spending more money on travel and leisure and entertainment. But then once you hit your mid to late 70s, it's going to slow down, and your mid to late 80s, it's going to slow down there as well. But you're probably going to have a spike in your later years with healthcare costs and long-term care costs. So what you should do is you should strategically plan for your cash flow to go along these spending stages. The next thing you do is you have to maximize your Social Security benefit. For many people, you might not want to hear this, but for many people, it may mean delaying your Social Security benefit, possibly even past your full retirement age. Personally, when we do planning for clients, I like to maximize the highest benefit in the household because the surviving spouse gets the highest of the 2 Social Security benefits. Then I always suggest, and we coach, to get your fixed expenses covered by fixed income sources. So here's what I mean here. Things like your food, shelter, clothing, fixed expenses that you have in retirement, get them covered by fixed income sources. Pensions, Social Security, dividends, maybe rental income, maybe it's annuity income. But typically what I find for households is this fixed income need that you have, it's about 40 to 60% of your actual income need in retirement. And then what we do is your variable expenses, things like travel, leisure, maybe gifts, things that you normally do, get those covered by variable income sources. And remember, do not take out during a market downturn. This is where your cash reserves come into play. Take from these if there's a market downturn. And you also have to have a diversified investment strategy that I'll talk about shortly here as well. So now that you've seen the income coordination strategies that we use for early retirement, let's look at how you can create a personalized retirement plan that ensures you have enough to retire comfortably at age 60. This is the exact framework that we use for our clients that we work with to create a personalized early retirement plan. The first thing that you have to do is this. You need to really drill down and think about, vision at this point in time, what your spending needs and your spending wants are going to be in your go-go years. You have to plan for this spending stage very, very detailed, because a lot of cost here can drain that portfolio at an early year, causing you to run out of money in a later retirement. It's also important here that you look at your family history and think about how we should be planning for your longevity as well. In addition to that, you should strategically invest your portfolio for the different stages of spending that I previously talked about. Money that will be spent right away in the go-go years should be in a guaranteed or conservative fund. Money that will be spent in 10 to 15 plus years in your mid-retirement phase, it should be moderately invested or placed in buffered accounts so you have some protection. then the last money that you're going to be spending 20 plus years down the road should be invested in equities for long-term growth. And it's extremely, extremely important that you rebalance these during market shifts and as you get closer to these different stages. For our clients, we use a financial planning software that analyzes your current spending along with market fluctuation and goals, wants, and needs that you have. And then what we do is we monitor this quite often during the year to make sure that you're on track with the goals and expectations that you've given us. Most importantly here, we update this plan when your life changes or the market changes. You should work diligently with your CFP to figure out the exact amount of money that you're going to need to accomplish your individual goals. However, I have found that oftentimes this is 10 to 12 times your annual income if you want to retire at age 60. Now that you understand what retirement really costs at 60, you can create a plan based on realistic numbers rather than dangerous underestimates. If you want more help planning your dream retirement, fill out the questionnaire below and I'll send you a video that analyzes your specific situation and shows you exactly how much you need to retire at age 60. I'll see you in the next one. This podcast is for educational purposes only and may include references to concepts that have legal and or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59.5, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.